What's going on, Penny boys and gals? It's your boy, What the Duck here, and it is time for another trading class video. This is a bonus trading class. Today's topic is going to be things that you can do during a red day, meaning when the market is red, which does happen, and it's important to know how to manage that. So let's go ahead and get right into the video. This is a handout that you can find in our free Discord. If you go to the free trading classes, completely free to everybody, you don't have to be a paid member. You can just click this right here and it'll take you to the handout. So here's our handout for trading on the red days or trading during a red market. As Benjamin Franklin said, an investment in knowledge pays the best interest. You know, before you start earning, you should try to start learning. If you try to start earning before learning, you're going to learn that you should have done exactly that. You should have learned, because otherwise your portfolio might end up in and earn. And now that I thoroughly hate myself for saying that, let's go ahead and go to the bonus video. The stock market is red. All of your stocks are red. Everything's going down. Facebook, stock, Twits, Weeble, everyone's freaking out. So now what? First thing you can do is manage your emotions. As you can see on the left, that's a heat map showing that the market is just that, red. And if you don't know what a heat map is, then you can definitely check out our Pennybois University course called Trading Tools. That's in our Pennybois University program, where we go over a bunch of different trading sites and tools that you can use, like Finviz, which has just this, a heat map, as well as a bunch of other free trading sites that you can use for your trading. So back to the course. So trading during a red market. If you're able to trade during a red day, chances are green days will be a lot easier for you. Kind of like when a baseball player puts a donut, or it's like a weight on their bat when they're about to hit next. They do that because it makes the bat feel heavier when they're swinging it. That way, when they go up to bat for real, the actual bat they're holding feels lighter because it has no weight on it, whereas you were just swinging with the weight. Now it's lighter. It's the same thing with the market. Being able to trade during a red market is kind of like being able to swing that bat with a weight on it. Now when the market's green, you take that weight off, it's easy to swing. But there are complications that go along with both, so you definitely should be checking out our trading psychology courses in Pennybois University to figure out how that all works. Let's go ahead to the next page. So one emotion that you might have is the fear of loss, or loss aversion is the fear of losing. Because as humans, we naturally have this built into our DNAs. We react 2.5 times greater to loss than to gain. It's really important to be aware of this, especially when you're making decisions in the stock market, especially during red days, because you're using your hard-earned money and you don't want to lose that. So when you see all of your stocks going down, you think to yourself, well, if I sell these now, will it be because I'm trying to protect my portfolio, because I'm trading based off of my plan? Am I making a smart decision right now based off of technical fundamental analysis and my plan, or am I doing it because of my emotions, because of my fear of losing or my loss aversion? Because there is a difference between being careful. In a red day, a lot of traders start to panic sell. This means that just making on-the-spot decisions without using logic or reason, without using technical or fundamental analysis, part of the loss aversion, the fear of losing. You see the stocks going down, you're like, all right, I gotta get rid of everything. I don't want to lose anymore. You're just doing that based off a split decision, then this is how you're trading with your emotions, not based off of a plan. Just because the market is red today or this week does not mean the sky is falling. So just take a breath, evaluate your positions, and as well as the market, and see what works best for you and for your plan, and make a smart, educated decision based off of panicking and not one based off of greed. So you're up on a lot of stocks, so you see the market is going down, as are some of your profits, but you refuse to sell because you want to see more profits. Stocks go up and stocks go down. You know, you can always buy back later. You know, there's no reason to be greedy when it comes to profits, because profit is profit and profits add up over time. All about managing your risk to your reward. We go over in Pennybois University, we go over how to use a risk to reward based plan, how to integrate that into your trading plan. Another thing that you could have that could negatively affect you in the stock market, especially during a red day, is being over optimistic. So maybe you got into the market when it was, you know, on the rise. All the stocks have been doing really well since you started trading. You think to yourself, nothing can go right? You think to yourself that nothing can go wrong. Well, that's wrong, because the stock market is a dangerous animal that does not care about your emotions or your financial situation. It's always important to limit your risk. Like I said, things do go wrong in the stock market. Some days you will have red days, which is why you want to limit your risk. You want to manage your risk and manage your emotion. So the stock market goes up, but it also goes down, like I was saying before. So don't let yourself get too comfortable in a green market, because it might end up clouding your judgment during a red one. This leads me to my next point, overconfidence. So like same deal, you've been killing it in the market. All your plays are hitting target. You're making a lot of money. All you see is green. You think there's nothing that you could do wrong, because a lot of traders refuse to sell when they feel this way, because they don't want to be wrong. You know, it's okay to be wrong. It's okay to sell for a loss. You know, that's how we learn. So if you've been making all this money and you see one play going down, you think to yourself, no, I'm a really good trader. I've been making so much money. I was right about this trade. I wasn't wrong. I'm not going to sell for a loss because that means I'm wrong. It's okay to be wrong, because if you are overconfident or stubborn, which is another emotion, well, then you could end up holding that bag. And it's better to limit your loss and be okay with being wrong than to be stubborn and end up holding a bag or selling for an even bigger loss. Kind of leads to blind hope. As a trader, that's not what you want to do. If you're a long-term investor, that's okay if you want to hold things long, but we're traders. We want to be in and out of trades, and we want to have money to make money on those trades. You can't do that if all your money is locked into a bunch of red. Another emotion that you could have is that an emotion of giving up. This can happen in two different ways. So either a trader might give up altogether and think that the stock market is too hard, where trading education is so important. But we have Pennybois University so that we can learn from our mistakes as opposed to just give up because of mistakes. Stock trading is not easy. Have you ever tried to ride a bike? Chances are, if you didn't have training wheels your first time ever riding a bike, you might fall over. If you ever tried skiing, chances are you're going to fall down before you get really good. And just like anything in life, you fall down sometimes and you dust yourself up and you get back up and you learn from your mistakes. So another form of giving up is seeing a red account and deciding to sell everything and to start over, which sometimes is okay. A reset can be a healthy way to get your emotions back on track and develop a new trading plan, because sometimes when you try to have a new trading plan or try to do a little reset and you have a bunch of red plays, seeing all that red might make you go away from your plan because of your emotions. Seeing all the red, it might make you feel in a certain way, and you start trading based on your emotions as opposed to your plan. A lot of traders end up quitting, within their first 3 months, and they don't know what they're doing. They get in there thinking that it's easy. The stock market is not easy. If it was easy, everyone would be doing it and we all be rich. But that's just not how it works. There are winners and there are people who sell for losses in the stock market. Our goal is to educate ourselves so we can be on the winning end. Education, or maybe you're just not trading based off of your strengths, which is why we go over trading psychology in detail so you can identify your strengths and your weaknesses and trade accordingly. Another mentality you can have that could affect you in the red market is a chaser's mentality. So you see your portfolio is red, you think to yourself, I gotta make this back, and I gotta make this back right now. You go to the Webull top gainers list, or you see, you go to the stock twits comments, or so you decide to throw money into a stock just hoping to make up your losses by chasing a top gainer or just chasing what everyone else is talking about. And this could usually lead to even more losses because you're not trading based off of a plan, you're not trading based off of a good setup, you're just literally just gambling. You're just hoping that, if you throw money into a random stock, you're gonna make your money back from your losses. And that is the chaser's mentality, which usually does happen a lot of the times when your portfolio is red and you think you're feeling a certain way, you're starting to feel emotional and you want to make those losses back. So, one way to help determine the stock market is just having a pullback or is showing signs of a crash is to use the free trading sites that we went over in Pennybois University, or even just go to our Pennybois Discord and just ask questions. So if the market is red, what you can do is you can bet against the market. You can make money when the market's going down. But this would be is trading a put, a option. Options are very risky. I would not recommend this if you don't know what you're doing with options. And we even have an options 101 class in Pennybois University. And our advanced classes are actually done by James Legends, which is our options shot caller. He is amazing at options and he does live streams. I believe it's every Sunday. Another way to bet against the market is puts. Another way, and a little safer way to make money when the stock market is going down, are inverse ETFs. These are bearish ETFs that go up when the stock market goes down. An ETF is an exchange traded fund, basically a bundle of stocks or commodities that you can buy and sell as one entity, just like you can with stocks. You can buy and sell stocks, or you can buy and sell ETFs. But ETFs, instead of just being one stock, is a bunch of stocks or commodities bunched together. So these can be bought and sold just like stocks, like I was saying, but it's a lot less risky than shorting, which we'll go over, or getting puts. So there are ETFs, or exchange traded funds, for all sorts of things, a bunch of stocks and commodities bunched together, in certain areas, whether it be airlines, oil, gold, or for instance with jets, instead of investing in American Airlines only, you invest in jets, which is an ETF, which is a mix of a bunch of different airlines. So it's like, a bunch of airlines all put together. And you would do this if you're bullish in airlines, because jets goes up, airlines go up. So if you're bullish in airlines as a whole, it's like as an entity, but you don't want to limit yourself to just one airline. Because if you only buy American Airlines, and let's just say American Airlines just doesn't do well, due to financial news or just bad news or earnings, but airlines are still doing well in general, you're still making money if you're in JETFs versus the ETF, as opposed to just being in American Airlines only. If you play fantasy football, it's kind of like having 8 players all on the same team. You have 1 player on each team. The Giants don't do well, and you have 1 player on that team, that's okay. But if you have 8 players on that team, they don't do well for that day, then your whole fantasy football team is not going to do well. Here's an example of the Jets ETF. So as you can see, it has a 10% of Southwest Airlines, 9% American Airlines. It has some United Airlines holdings. There's a bunch of different airlines that equals the ETF. And these are the top 10 ones that that JETS, J-E-T-S is. Here's a few more examples. You have a JNUG, which goes up when gold is up. A JDST, which is a bearish, goes up when gold goes down. UCO goes up when oil goes up, and SCO goes down. Right? SCO goes up when oil goes down. Also goes down when oil goes up. And you can also bet against certain markets as a whole, like SPXL and XPXS. So XPXL goes up when the S&P 500 is up. XPXS goes up when the S&P 500 is down. There's TQQQ and SQQQ, which do the same thing for the NASDAQ, with TQQ being the bullish one and SQQQ being the bearish one. And then there are other ETFs as well that you can use, like SPY and iPath, S&P 500, VIX, other short-term futures, and many others, which we actually do go over in our alumni bonus classes in our ETF bonus class. But as you can see, you have TQQQ, SQQQ. It's nice to put them in your watch list together. One goes up, the other one goes down. It's almost identical. And A, it's a good way to see how the market's doing, but B, it's a good way to, the market's going down, to bet against the market, getting the bearish. Let's discuss now what to look at when an alert is under entry. So, it's a red day, and an alert came out a few days ago, but now, the market's been red. So the alert, let's just say, was, buy at $20. Well, let's just say the stock is now at $18. So you see it's way under entry. You haven't even got into it yet. Does this mean it's on a discount? Is it a good buy? Well, picture this. So you go to a car dealership, you see a 2018 BMW 5 Series 530e. It has 25K miles on it. So you know that, usually worth 30K used. But this one's priced at 20K. Right now, this one's priced at 20K. A huge deal, right? Well, why? You want to wonder, why is it a good deal? You're not just going to blindly buy into it because it's a good deal. You want to know, why is this a good deal? So you tell the dealer, well, show me the Carfax. So you see the reports in the car, you do an inspection. It turns out that the engine is busted, the radio doesn't work, the parking brake is stuck, one of the windows won't open, and the lock on the passenger side door doesn't work. Well, thankfully, you did your due diligence before blindly buying the car. Same thing goes with the alert. You want to make sure the same thing. You want to make sure that the alert didn't go down because of bad earnings, or the alert is on a discount. Technical reasons, because the market's just red. That's why it's not a good deal, but it's still a good stock to buy. It's all doing your due diligence. Make sure it's not because of bad earnings or bad news. Or you also want to go into the Discord. Whoever did the alert, be it Big Quench or Mr. Stockpot Profits, you want to see what they say about the alert. Maybe they said, oh, this bad news happened. I stopped out for a 3% loss. Or however, if you go into the Discord and you see, I'm still developing my position because we buy in slow using our PBU buy-in method, which you can definitely check out in Pennybois University. Using this method, buying in slow, you can take advantage of the red days by developing a great average. During the green days, you can make even better profit. Of course, with stocks, you still want to do due diligence on the stock in itself to make sure that, stock that you want to get into and it fits your plan. But as far as, seeing it as if it's still a good alert based off the actual alerter, if it just came out and it's still at the same price, like a brand new car, it's a brand new alert. Used car would be an alert that might be a week old, that went down a little bit or even up a little bit, that you want to do a little bit more digging in. So we also recommend, especially during red, especially for red days, we recommend to keep around 20 to 30% of your portfolio in cash. This way you have capital available, or if there is a red market and you want to take advantage of the dips, take advantage of the price drops. You want to have that cash on hand for those red days. You want to have cash on hand in case that happens, because if a Tesla forward split happens or stimulus news comes out and there's all these different potential plays that you can get into, but all your money is in other plays, you don't have any cash on the side, well then you can't take advantage of that happening because all your money is tied up. Or if an alert comes out that you really want to get into, you really feel really confident about, it's good to have that 20 to 30% portfolio in cash so that you can use that money to get into that play. If you're not in Pennybois University, you can definitely join now at pennybois.is/pbalerts to get premium stock alerts. We have 30 trading education classes. 22 of them are for premium members. We have a bunch that are available for free members. We also do giveaways. We have cash giveaways and so much more. You can definitely use WTD15 for 15% off. But yeah, that is the Pennybois University trading class. We have a bunch more bonus classes coming up. Definitely take advantage of. Once again, my name is What the Duck, and I hope that you join me next time for the next bonus trading class. But together we can all make some bread.